This one looks particularly interesting. It says, greetings to you. My name is Ike from Anambra in Nigeria. I built a 12-room guest house in a good location, but unfortunately, I couldn't complete it. I managed to arrange the 5 rooms downstairs to start, and to my surprise, it has been moving well. I am very impatient and I want to finish the upstairs and also give the whole place a nice and attractive look. And here comes my challenge. Is it right to look for partnership or a loan to finish up, or should I just be patient and grow the business by plowing back the profits till I get it to the standard that I want? So, in summary, he has developed property and the property has not been completed, but he was able to finish the property on the lower floor. And to his surprise, he's getting patronage. So he's filling up the rooms he has downstairs. And that has given him ideas. He's now thinking, now that the rooms downstairs are moving, why don't I just complete the structure upstairs so that I can bump up my revenue? So he's asking, should he take a loan or should he do a partnership? So the advice I'm going to give you will be in order of risk. I have three suggestions to make to you. The first suggestion has the lowest risk. The second suggestion has slightly higher risk. And the third suggestion has the highest risk of the three. The first suggestion is you have 12 rooms, 5 are operational right now, and you're making revenue from 5. The lowest risk option is to accumulate the money that you're making and use that capital to complete the outstanding structure. So this strategy is more or less, this is a financial strategy that involves the use of your internally generated funds to grow the business. Now, while this is low risk, because it is your money, you are not accountable to any other person, you're not taking money from anybody. While this option gives you a level of independence, right, that allows the business to stand on its own, the downside of using your own funds is that it can be slow, right? You may not be able to finish the property when you want it and how you want it. In fact, with the revenues you're getting now, you may be able to complete the rooms, the outstanding rooms, maybe just one at a time. You may be able to complete the outstanding rooms one at a time, which may not really be what you're looking at. I think you want to have the opportunity to improve the entire property and also complete the ones that are upstairs that you haven't finished. So like I just said, that's one option. Using the money the cash flows you're getting from the completed property, you can use that to complete the outstanding property. But I've told you what the downside is. It's a slower option. If slow doesn't matter to you, that's why it's the number 1 on my list. That would be the first option for you to take. If you want it to be faster, the second option will be to take a loan. And the reason I am suggesting a loan before equity is this. When you are starting a business and that business has not made any sales, that business is still very risky. And when a business is still risky, particularly in the early years, the best form of capital to raise is equity, because what equity does is it allows you to share risk with the investor. So the investor brings in their money, and the nature of equity is that the investor only makes money if you make money, which makes sense for a new business because you've not made any money. So you're taking risk, right? But the moment you find that the business has merit and is making money, a business that is making money is a de-risked business. So you can have 2 identical businesses. One business has started making sales. The other business has a big office, has an advanced website in terms of technology, has an app, and has about 25 staff, but has not made any sales. He has a big office, has staff, has all those things, has not made any sales. Another business doesn't have an office, has only about 2 staff, but is making regular sales. Which of these 2 do you think has higher risk? So from the outside, people think that a business that may look majestic on the outside is a viable business. As long as you're not making sales, you're not a viable business. Until a business starts to make sales. In fact, what sales does is sales significantly cuts down the risk of a business. So if a business has not yet made sales, I would recommend that you go with equity. Because like I just explained to you, equity allows you to share risk with the investor. But the moment your business makes sales, you are going to be shortchanging yourself by taking equity. Because what you need the equity for is to share risk. But when the business is already making sales, there's still risk, but it's not like huge risk. What you really need at that point is money to, okay, maybe let me explain this another way. When a business has started but it's not making sales, it's like you've put firewood together, but there's no fire, there's no smoke. There's no smoke. So you've put firewood together, there's no smoke. So the question is, will there ever be smoke? Because smoke is a sign of fire. And by smoke and fire, I mean sales, money coming into your business, right? So if you have a business and it's all just firewood together, but there's no smoke, which is a sign that there may be fire, that's a risky business. But the moment you start making sales, no matter how small it is, you are like firewood that has smoke coming out of it. What it means is that there is merit here. People want what you are selling. They are willing to give you their money, and this business has potential to be profitable. So, which would you choose? Which of these would you choose? A pile of firewood that doesn't have any smoke, so there's no sign that there could be fire, or a pile of firewood that you can see smoke billowing from it, so there's sign that there could be fire. That is what a business that is making sales is. So the moment you're making sales, I would not encourage you to go for equity because you're not as risky as a business that is not making sales. What I would encourage you to do is to go for a loan. A loan is a strictly financial arrangement, unlike equity. Equity is I give you money and I become a part owner of your business. There are strings attached to equity. With a loan, there are no strings attached. The investor gives you money or the bank gives you money and you pay interest. It's a pure financial relationship. There are no strings attached. As long as you pay your interest and you make the repayments and meet your obligations under the loan, it's very straightforward. So a loan can be beautiful when you're already making sales. And the second reason why I would suggest a loan is this. Besides the risk option, a loan is, in terms of, from your perspective as the owner of the business, taking a loan is less risky because it's just a financial transaction. The second benefit of a loan is, as long as you are making sales, you have the cash flows to repay the loan. That's why a loan gives you an advantage. You have the cash flows to repay the loan once you are making sales. But if you're a new business that is not making sales and there's no cash flow, a loan is going to crush you. The moment you take a loan is going to crush you. So my advice to you is that those rooms downstairs that are generating cash for you, look at the cash flow profile of your business. In a typical month, how much cash does the business make? Why I'm asking you this question is that your monthly cash flow is what will tell you if you are able to pay back a loan, and will also tell you what's the maximum loan you can take. So to give you an example, since this person is in Nigeria, if, for example, at the end of every month, you are doing 1 million in cash, that is how much you make in cash from the 5 rooms, right? That is the cash flow, net cash flow you are getting from your 5 rooms. What it says is that as long as you can take a loan that doesn't ask you to pay more than 1 million, because when you take a loan, there are monthly repayments that you make. As long as you take a loan that doesn't require you to pay more than 1 million. In fact, I wouldn't ask you, I would prefer that you don't stretch to 1 million. I would stick to like 40 to 60% of your net cash flow. So instead of 1 million, I will not plan with 1 million. I'll plan with 500,000 or 600,000. So how much can I take as a loan that will require me to pay 600,000 every month for the next 6 months, for the next 1 year, for the next 2 years? That's what you're looking at. That's how you know how much loan your business can afford. So a mistake that businesses make, I think somebody asked a question related to that. A mistake that businesses make is that they think they can take any amount of loan and pay back. There's an amount of loan you take and it will crush your business because your business cannot support the cash flows required to service that loan, required to pay back that loan. So if you take a loan of a certain size, it will crush your business. So the way and anybody who has taken a loan from a bank should have some kind of idea of what I'm talking about. Before you get a loan from the bank, there's something they normally ask you. They ask for your account statements. They want to look at your cash flow. They're looking at your monthly cash flow. So if they know how much you get as a salary, what most banks do is that they will give you a loan that requires you to pay no more than 40% of your salary to service that loan. And I would ask you to bring over that same practice to your business. So look at what 40% of your net cash flow is. That is the amount you can use to service that loan every month. And then that would determine how much you can take as a loan. So I think a loan is more risky than using your own money to grow the business. The advantage of the loan is that it is faster. You can take that loan, finish up the property, and when you finish up the property, it will even start giving you more cash flows that you can use to repay the loan or even repay the loan faster. So a loan would give you speed. A loan will give you speed. You take that loan and you can use it to complete the structures that you have. So that's one way you can play it. The third option is equity, and equity is not just the most risky option, in my opinion. It's also the most problematic. The moment you bring in somebody as an equity partner, that person is a part owner of your business, and there can be complications because some people don't know where to draw the line. Because you're an investor in the business, or because you're an investor in my business, doesn't mean that you should then come and interfere and tell me how to run the business. And the truth is, that's what you're going to get. You might even get issues like rumors going around saying that you're not really the person who owns that property. That is some guy, that the guy gave you money, he's your partner. You can start having all. So one of the biggest problems I notice that entrepreneurs have with equity is that it invades on your privacy. It affects and undermines your control, and it affects your independence. Many business owners, one of the badges of honor that they wear is that they take pride in their business, that they started this business from scratch and look at where it is now. Imagine somebody coming in halfway when you've already done most of the work, and is coming and is trying to take the glory. I'm sure it's not going to rub off nicely on you. You might not like it, right? So that's the downside with equity. The moment you bring in somebody, your business is already making sales. All you just need is you need capital to scale it up. You can get that from a loan. You can get that internally, even though it is slower. But that being said, I'm not totally going to write off equity, even though it is my most risky option, my most risky suggestion that I'm giving you. You may be able to find the right partner that would help to grow this business in ways that you cannot even imagine. So one example in my mind is, if you have a partner who has a background or experience in hospitality, either has run guest houses before, has run a hotel, somebody that has relevant experience about the business, that totally flips equity for me, because it's like you're getting two things for the price of one. You can get the equity, you can get money to build out this guest house, but your biggest problem may end up being management, because you don't know how to manage the place. Even though you've invested money in this place and it has potential, due to poor management, you can totally damage the prospects for that business. So even when you solve the capital problem, operations can become a bigger problem for you, particularly around how do you run the hotel and make sure that you keep it viable. But if you get a potential partner who is willing to put in equity and has relevant experience in the kind of business that you're trying to build, that experience can become invaluable. That partner will be bringing something that would have cost you a lot of money, but you're getting it for free, just because the investor has an experience in that kind of business. So these are, if you're already used to how I give advice, I don't give prescriptions. I don't tell you exactly. If I do anything, I show you how to properly think about your problem, because the truth is, you are the one in the driver's seat, and I recognize that you may not be able to see all the angles, which is why part of the solutions I give you is to help you see all the angles, so that you can choose the option that is most relevant and most appropriate for your kind of business, right? So that would be my suggestion. I've just given you 3 possible solutions. To recap, I said you can use the money you're generating from the 5 units that are already live and reinvest it into the business. What are the advantages? It keeps you independent. You're not answerable to an outsider. It's your money. The downside is that this option is slower. You will end up building those rooms just one by one, because the capital you are getting is trickling in. You're not getting it in bulk. The second option I talked about is to get a loan. Why do I like a loan? You have achieved a very important milestone in the life cycle of any business, which is what? Sales. A business that makes sales is many times better than a business that doesn't make any sales, no matter what that other business has. Whether they have a fantastic office, fantastic website, they have staff, they have PhDs. If you're not making sales, forget it. So any business that is making sales, fundamentally from a risk perspective, is less risky than another business that is not making any sales at all. So since you're already less risky as a business, equity is no longer as attractive as it should be. Equity is usually attractive when you are still a risky business. You need somebody that will give you capital that is patient. And by patient, it means that you are sharing risk with that person. Loans are not patient. Loans require that you start paying back. That doesn't mean they are bad. What it just means is that if you don't have cash flow, don't touch a loan. But in your case, you have cash flow. The 5 rooms are giving you cash flow. You can use that cash flow. You can take a loan, use the cash flow. I've told you the dynamics to look at so that you don't end up taking a loan that you cannot service, right? Use the cash flows, settle the loan. What is the advantage of the loan? It will give you money in bulk, and a loan does not affect your independence. The person who gives you a loan has no right to tell you how to run your business or what to do. A loan preserves your independence, preserves your privacy as a business, preserves confidentiality, which is fine. Equity, I told you, for me, is my least favored option. But I told you that there is a certain circumstance under which I would consider equity, which is that you get an equity partner who has relevant experience in the business and will help you manage the operational burden of running that business. So if you get somebody who has any knowledge of real estate, hospitality, running guest houses, running the operations of a business, that would be a fantastic asset. And what that would mean is that if you take money from such a person, you are getting 2 very valuable things for the price of 1. You are getting capital and you are getting an asset, somebody that can help you properly manage that business. Like I said, capital is not the end of your problems. You may, like for a guest house, you may end up solving the capital problem. The biggest problem that takes the place of capital becomes the operational risk. That's your kind of business. The biggest challenge you can face is managing that business. There are hotels that are beautifully built. There are guest houses that are in fantastic locations, solid assets, but they are poorly managed because the person who owns it doesn't know how to run a business, just thought it was just a case of, open a guest house, it will just be minting money for you. No, these businesses, don't forget, they are service businesses. A guest house is a service business. And service businesses are harder to run than product businesses. A product doesn't talk. A product just does what you want it to do. And the moment you sell the product, it's gone. A service business means you have to deal with customers. Customers have feelings. You have to cater to their needs. You have to pander to them. You have to more or less like pet them. You have to patron, all kinds of things. So service businesses are from an operational perspective, service businesses are harder because you are dealing with human beings compared to products. If you put a product on the shelf, you sell the product, it's gone. You sell it to the customer. Customer takes the product and uses the product. Fine. But when you're in a service business, every sale, you have to manage the customer. You have to manage the tenants. You have to. So it's not something you want. I know you didn't ask for this, but I'm just giving you an idea of what you're about to face after you solve the capital